Well, good morning and welcome to 2021's Good Money Week. My name is James Alexander. I'm Chief Executive of UKSIF, and I'm delighted to welcome you all to the start of this, what promises to be a fantastic and very exciting week. We have a week dedicated to breaking down the barriers to retail engagement in sustainability. We've got fantastic sessions, fantastic speakers lined up, and a week of tangible and actionable content. And that's what we're aiming for. And in fact, our wonderful agenda for the next few days will start with the launch of great new research from PA Consulting, followed by panels on the importance of retail engagement, future regulation, innovation, greenwashing, and much more, as well as an series of industry-focused sessions looking at investment, banking, and pension funds. We're pleased to have some exciting partner events also taking place both this afternoon, tomorrow afternoon, and on Thursday. And you can see the full list of the upcoming events on the our upcoming events section of the Good Money Week website. So please do check out those partner events as well. Before we begin, I'd quickly like to run through a few logistics and particularly to thank our sponsors, which are PA Consulting, Lion Trust, and Aberdeen, as well as our partners, which are TAM Asset Management and Triodos, and our media partner, which is IFA Magazine. Thank you all so much for making this event possible this week. It really is thanks to you that we're able to put this on. So thank you for all of your support. All of the sessions that we have this week and today in particular are interactive, so you can use the Q&A box at the bottom of your screen to ask questions and help shape our discussion. Please do use that box. We will make sure that we come to you and your question will be asked. So without further ado, without further logistics, I'm delighted to introduce our first speaker, which is Mark Lanslot, business design and sustainability expert for PA Consulting. Mark leads PA's sustainable finance proposition, engaging with clients from across the UK and Europe on sustainable strategy, innovation, risk, regulation, and transformation. His trade is as a business designer, helping organizations develop new business models and operating models. He co-delivers a course at Ashridge Business School, is a co-author of the Operating Model Canvas book, and is a member of the UN Global Compact's Expert Network. So I can't think of a better person and organization to be kicking off Good Money Week 2021. So Mark, thank you so much for being with us, and over to you.
Thank you, James, and it's great to be here this morning. Every disaster movie starts with someone ignoring a scientist. Just watch Jurassic Park, Jaws, Contagion, even Independence Day. After decades of warnings by scientists about climate change and exceeding planetary boundaries, we are in the second act of a film of our own making, watching wildfires, floods, and droughts. Who will save us? All of us here today know that money makes the world go round, and that money has a critical role in our response to climate change and sustainability challenges. ESG has entered our language, along with concepts such as responsible investment, stewardship, TCFD, stress testing, and much more. But I put it to you that someone is missing from the discussion about sustainable finance, the man and woman on the street whose money we are often looking after. We set out to better understand what the end consumer of financial services thinks and feels about sustainability and sustainable finance. We surveyed 3,500 individuals in the UK, the Nordics, and the Netherlands. And today we're excited to launch our report. This morning, I'm going to share the headlines from our findings. Next slide, please. So why should you listen to me? Since 2015, my professional mission as a consultant has been to help business create a sustainable, decarbonised future. As James said, I lead our sustainable finance work at PA Consulting, working with banks and financial service firms on the opportunities, and more broadly, have experience of helping other sectors make the shift to sustainable business models. I believe business can and must be the platform for change and go beyond regulatory compliance and managing risks to embrace the commercial opportunities that climate change and sustainability present. Ingenious businesses are finding ways to drive the bottom line and improve impact on our world. It doesn't have to be a trade-off relationship. Briefly, PA is a global innovation and transformation consultancy. Founded in the UK in 1943, we believe in the power of ingenuity to create a positive human future in a technology-driven world. We are nearly 3,500 consultants, engineers, scientists, designers, and innovators working from 19 offices around the world. In financial services, we work with many of the world's leading firms on strategy, new product development, digital engineering, and transformation. and we have expertise in fraud, financial crime, risk regulation, sustainability and climate response. We work with both the Ellen MacArthur Foundation and the UN Global Compact on sustainability, and in sustainable finance, we focus on looking beyond regulatory obligations and risk of non-compliance. In the next 10 minutes, I will cover the background to our research, what we set out to do, secondly, what we found, and thirdly, how we believe financial service firms can harness this opportunity. We'll then have a discussion that James will facilitate alongside Gemma Woodward from Quilter Cheviot and Clive Emery from Invesco. Next slide, please. So what did our study cover and why did we undertake it? Consumers are increasingly attuned to the sustainability impact of their actions and of the brands they buy from. We wanted to find out more about what consumers want when it comes to sustainable finance. What issues really inspire them? What barriers are stopping them making more sustainable financial choices? And where do they need to focus? To understand, we interviewed 3,500 respondents in the UK, Denmark, the Netherlands, Norway, and Sweden. We sought to meet representative numbers across ages, education levels, and lifestyle, as well as a 50-50 gender split. The average income of respondents globally was just under 50,000 sterling, with personal savings of just under 10,000 sterling. Next slide, please. We found that consumers truly care about sustainability. 86% said they care about it, and 46% try to live sustainably. An overwhelming majority of people expect sustainable finance services to become the norm, 93%, and almost half expect this to be the case by 2025. But we wanted to test if consumers really understand the impact that their financial service choices have on sustainability. Finance is the biggest lever many consumers have to live sustainably. Studies have shown that changing where your pension is invested is over 20 to 21 times more effective for reducing your carbon footprint than a more sustainable lifestyle. Next slide, please. But when we asked what the best ways of living more sustainably, just 12% of our respondents ranked sustainable finance products at the top of that list. Recycling came top, along with flying less and eating less meat. This is the backdrop to the detail of the findings we'll now go through, a significant underappreciation by consumers of the impact of their finances on a topic that they say is important to them. Next slide, please. So what did we find? And again, please, next slide. So our first finding was that customers want authenticity. They want financial service firms to be walking the talk. We found that only 17% think financial institutions do well at contributing positively to the environment, to social issues, and conducting themselves responsibly. 63% thought firms could build more loyalty by offering more sustainable options, and 60% think that offering more sustainable options would also increase brand value. Our results demonstrate the opportunity for the sector to do more to build credibility on sustainability. Over half think that financial institutions are absent from debates around sustainable living and conscious consumerism. And our oldest age group, the over 60s, were most sceptical of what FS firms are doing. Next slide, please. Our second clear message is that customers want to understand how to apply sustainable principles to their finances. We found that 58% don't think firms do enough to educate existing customers on sustainable finance products. 41% are under the impression that sustainable finance products are less effective than non-sustainable products, and almost half, 48%, don't know how financial products can help them live more sustainably. This is in contrast to the reality. The Make My Money Matter campaign has shown that changing where your pension is invested is 21 times more effective for reducing your carbon footprint than eating less meat, flying less, or reducing water consumption. Another research by Nordea Bank showed it could be as high as 27 times more impactful. So this is an opportunity for firms to engage and educate their customers and to provide the information and guidance that they're looking for. Next slide, please. Our third finding was that consumers want to embrace sustainable products and services. 52%, over half, describe the need to introduce them as urgent. and 53% say they'd use more financial products if they were more available and accessible. 62% think that the finance industry is missing a big opportunity by not targeting the older generation who traditionally have more to invest. Our survey revealed that the 60+ age group cares more about all areas of sustainability than any other age group. For example, 81% of this age group care about environmental protection compared to 67% of the youngest age group. We hear a lot about how millennials and Gen Z care about the future of the planet, but it's not just that generation. So those are our 3 headline findings. Customers want authenticity, they want to understand, and they want sustainable finance products and services. Next slide, please. So if consumers are ready for sustainable finance products and services, how can financial service businesses harness the opportunity? Well, we think there's 3 steps. Next slide. Step 1 is to build credibility. Trust has been an area of improvement for firms for some time. Our survey reveals consumers aren't confident about firms' commitment to sustainability. Stricter regulation is on the horizon, for example, the UK Green Taxonomy and the EU Sustainable Finance Taxonomy, but we believe firms need to go further and faster. To build credibility, firms need to make sustainability business as usual, to integrate it throughout their business, include it in job descriptions and KPIs, incorporate it into products and services, into investment decisions and lending criteria, to measure the impact of operational activities and embed it in the supply chain management, and then be honest about and transparent about the progress they're making. And firms need to get credibly involved in the broader transition and on specific issues where they can help. For example, in the UK, 22% of our carbon emissions are from heating our drafty homes. To solve that, we need deep retrofits of the existing housing stock, installing proper insulation, solar panels, energy storage and heat pumps. People are keen to make those changes, but the significant upfront cost and long payback periods are a barrier. At the moment, there are fewer than 30 green UK mortgages on the market, and these are mainly targeted at new builds. So how can financial service firms engage in that debate and help unlock this retrofit challenge? Next slide. The second step is to engage and educate customers. Our survey reveals some significant misconceptions around sustainable finance and a real need for clearer guidance and information. 59% say they'd be open to learning about new types of finance if it was made relevant to them and their lifestyle. And 54% will be open to new ways of funding their life goals using sustainable finance, but need more education. Most are seeking additional facts and reassurance, wanting to be fully educated on all the detail when considering new products and services. But we also know people can feel overwhelmed by the amount of information about sustainability, so there's a balance to strike there. Firms need to prioritise the customer experience. How do they help customers navigate these choices and feel confident when they are making informed decisions? Thirdly, firms need to innovate. At the moment, we see a tendency to green existing products with simple add-ons, for example, making a donation to an environmental charity. Whilst this isn't necessarily bad, it's not going to meet the growing demand and opportunity. A bolder approach is needed to create new and enhanced products and services. Innovation requires insight into what customers will want. This can't be a passive exercise, but requires creativity and empathy to uncover needs through engagement. When we work with clients to do this, we bring forward-leaning customers into the innovation process so we can uncover needs and motivations so they can respond and give feedback through the process. To innovate, firms need to look beyond their current business activities. Firms should engage with a broader network of players in the ecosystem to best meet the needs of customers who want to live more sustainably. We've seen examples of this. Challenger Bank Klarna teamed up with Doconomy to allow customers to see the carbon impact of their shopping, and NatWest joined forces with Octopus Energy to offer discounted electric car charging points. Next slide, please. So to recap, our research shows that consumers are ready for sustainable financial products and services. We believe it's a call to action for firms to act, and act now and go further and faster. We know that customers care about sustainability, but most don't currently understand how their financial choices contribute to their own sustainability impact. But this will change. We have seen sustainability issues rapidly break into the mainstream in recent years, so don't expect the change to be linear and predictable. The question then is, are you ready to empower the conscious consumer to live more sustainably? So to close, our report is launched this morning. It's available from our website. You can see the link here. We hope this research and data points will help you make the case for change in the industry and for investment and innovation to empower the conscious consumer. Thank you.
Mark, thank you. That was absolutely fantastic. And I think sets a perfect stage and backdrop for the discussions we're going to have at Good Money Week this week. And I think that's exactly what we had hoped for. And thank you so much. I think, just there's so much to dig into with this. And so I'm really looking forward to not just, in the session we've got immediately coming up, but actually the course of this week actually being framed and underpinned by this research. Our conversations this week helping to answer some of the core questions. How do we educate? How do we innovate? How do we build authenticity, understanding, and create the sustainable finance services that consumers want us to create? So I think this is a really, really great piece of work, and looking forward to now discussing it further, both with you, Mark, but also with our two other panel members. And so I'm pleased to introduce Clive Emery, who is from Invesco, fund manager with Invesco. Clive joined Invesco in July 2015 and serves as a fund manager in the multi-asset team. Initially focused on absolute return multi-asset solutions, his attention has moved to ESG with the development and launch of the Summit Responsible range and targeted responsible multi-asset funds. Clive has pioneered responsible asset allocation, a separate and additional step to the traditional tactical and strategic allocation process of multi-asset investing. In addition to writing a number of white papers on the rollout of ESG multi-asset investing, he has a leading role in the development of net zero at Invesco. So, Clive, great to have you on the panel. And our second panel member is Gemma Woodward from Quilter Cheviot. Gemma is an investment professional with 20 years experience and spent the last decade or so focused on managing charity and other larger entities with complex ethical, SRI, and ESG policies. Gemma works with charities to define and implement an investment strategy and asset allocation that meets the charity's requirements. She's found herself combining working as an investment manager on the central charity team with a firm-wide role on leading Quilter Cheviot's responsible investment approach. Gemma, really, really pleased to have you here on the panel as well. So we'll maybe turn to you, Clive and Gemma, first, to basically, I guess, to react to what Mark said. So, how do you feel that the PA consulting research, meets the understanding that you have from your customers and from the people you work with? And what are your initial response and reflections on Mark's presentation? So maybe Clive, will start with you.
Yeah, thank you, James, and thank you, Mark. And I think my initial reaction is yes, yes, yes. I think the reality is that the research we've done and the clients we speak to have a greater expectation in how finance can help. And the great news is that as the research indicates, it's already 21 times more effective. So we're starting from a good place in that there is this ability to have influence. The concern I have, and the way I've explained it to my wife, is that for hundreds of years, financial operations have been focused on one component, delivering financial returns. And we're now being asked, in addition, to do good. And that's a very amorphous and broad spectrum, and depending on people's points of views, and whether it be gender or race or climate. And that's a huge spectrum of additional components. Now, I am all for the improvement of stewardship of capital, from just being a profit maximization approach to having those non-financial components. But it does feel a little bit like we've gone from the blunt knife of just delivering financial returns to being asked to become sort of heart surgeons. And we're building out the tools and the capacities, the education to get there. And that moving from a sort of niche market of very deep green SRI impact type of products in the investment world, in investment management, and then broadening it out to a mass market component is very complex. And it is a huge request and requirement for fund managers and asset managers to become the stewards of doing good. Now, that is not something we should shy away from. It just is a very significant request and ask. And I think the nascent level of this mass market approach will improve the requirements, the focus, and I think net zero is going to be a huge component in improving that element of stewardship. But when you talk about credibility, one of the major difficulties, if you're asking to solve the world's ills and you're starting with a simple toolkit, which is being developed, that's going to impact credibility, because if the expectation is perfection and your ability to deliver that is not as good, that will be difficult. But I do believe there is significant interest and shift and desire from all asset managers, because the client demand, as indicated by Mark's and PA's work and work we've done, is 80 to 90% of clients want to invest sustainably. And therefore we need to address that. And I think there is a huge move to do that. But it is also unbelievably complex, and Mark indicated that in his speech. And the ability to deliver these complex solutions while also being simplistic enough to fit into people's lifestyles for them to understand is not an easy conundrum to deliver. But innovation is crucial. So I think the research confirms my view that people want to invest more sustainably. They want to put money where their hearts are, because they also know they can get returns. And if you can do well and do good, yes. And the industry will need to develop. Now, I look at it through the lens of asset management. That is going to be the case across all financial services in terms of adding that componentry as a steward of capital at the broader sense of its meaning, in terms of reflecting, bondholders and shareholders, but also, ensuring that staff are treated well, that the greater society is also served, as is the environment. And I think those components will increasingly be framed. So I'll leave it there. Maybe Gemma.
Yeah, thanks, Clive. That's really, really helpful. Gemma, just come to you in just a second, but just a reminder to everybody listening that we have the Q&A box. So please do put your questions in the Q&A box at the bottom of your screen, and we'll get to those on the panel as well. So Gemma, really keen to hear your reflections on Mark's presentation.
Thanks. I think one of the most pleasing is that it's not just about millennials, because you do get bored of this trope that it's just about millennials. Our average client is in their mid-60s and they care. And I think that is really important, that we don't just put it in onto a generational basis. I think there are a lot of myths still out there, and we know this. We've tried, like everyone tried to bust some of these, one of them being that if you're being sustainable or good or whatever, you're sacrificing returns. And we know, that is now really needs to be put to bed. But I guess that comes on to the point about financial education. Am I surprised about some of the low numbers? No, because I think probably as a wider population, we are all probably not that well educated on finance, across the globe. Certainly I know efforts are made to start, educating people when they're at school, but the average person, what do you know? I mean, for goodness sake, I get advice on my pension, and I'm an investment manager because I'm not a pension expert. So it's really important, I think, in the whole picture of that this is another complexity on top of something that already is a complex topic to people, and something that where it's a bit like me when I, someone needs to fix the boiler, all I hear is blah, 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 blah. And I think that's what a lot of people hear about finance in the first place. And that is something we've got to deal with. And I know, because Clive and I know each other from various committees, and trying to put stuff into simple terms is really difficult, and we don't all agree as professionals. So that's part of the problem, because everyone will have slightly different takes on what means what. And so that is, we are part of the problem as an industry, because we're putting out an awful lot of verbiage, but not necessarily being clear. And I think, taking Clive's point, we are going from 0 to 100 in a lot of cases. If you look at what comes across your desk these days, it is every single aspect that you're looking at. And so there's an awful lot of work that needs to be done, not just from a regulatory basis, and there are enormous costs associated with some of that as well. If you look at the FCA estimate of how much it will cost to do TCFD reporting, but also to actually do the right things that you should be doing as an investor. that takes different skill sets. It takes a cultural change as well in some cases in terms of how our mindsets work. And that is very difficult. That's not just like, well, we'll buy loads of data and it will all be sorted. That, takes a bit longer. And I think, one of the big dangers at the moment is greenwashing, because it's not because people are necessarily doing it, but because people aren't clear enough, or the end consumer isn't clear about what that product or what that fund or what that strategy is actually about. So I think, any kind of research like this is always really, really helpful, because it does inform us more and more about what we do and how we keep trying to educate our customers. We're all doing COP26 events, I think. I mean, you can't, but is that what our clients need? We think it is, but how do we keep judging what those requirements are? And I guess it's more and more thinking about how you incorporate, responsible investment topics into, say, the annual or biannual client or customer surveys that you do, so that you're taking that temperature, because otherwise you could quite well be doing something and actually that's not what people are looking for at all. So I think it's really interesting, and it will continue to evolve, no doubt.
Yeah, thanks, Gemma. Really, really helpful. And I think, you raised the point about the 60 plus being the group that cares most. That to me came as a bit of a surprise, and because we typically think it's the millennials, as you say. I mean, Mark, what else in the research came as a surprise to you that we can perhaps, that wouldn't necessarily be what you'd expect?
Yeah, I mean, I think that was a real sort of standout surprise for us, I have to say. I think some of when we kind of looked at what sustainable finance products people expect will be useful or interested in, clearly things like savings came top, and I think that's probably not a surprise. But also a lot of interest for mortgages. So the point I made about retrofits, that was the kind of second area that people were looking for potential solutions to address what's a big part of their kind of footprint and impact. So I think it's not just about savings and pensions. So clearly they have a huge impact. Mortgages, we see kind of credit cards and payments. So the kind of Klarna and MasterCard examples, where it's starting to give people visibility of the impact of what they purchase through their credit cards. Again, I think some of those are quite powerful in terms of nudging and helping people make better choices in their own lives. So it's not just about the kind of stewardship concept.
So it really is across all the different products that financial services creates and offers. And Clive, Gemma, what are your thoughts about the kind of range of different products? Mark as well, feel free to jump in on this. The range of different types of products that are offered, and just we need to take a sustainability lens across everything that we offer as an industry.
Yeah, I mean, totally agree. I mean, Gemma highlighted before with this sort of giant step, and I think what we're moving from is an environment where you've had the sort of, there was a wonderful, after a panel I was on a few months ago, someone who was listening, who was an IFA, shared a wonderful sort of piece, which was a behavioural, some analysis that they'd done. And they sort of divided the world into sort of 4 categories of people in terms of ESG. And the first were the advocates. They're super gluing their hands to tarmac near you. And you've got people really campaigning there. And then you've got the fashionistas, as they describe them, as people who want to sort of, virtue signal, but they might not do a huge amount. They'll wear the band, but they probably then go to the march. And then you get the pragmatists, who are the largest group, and then you get the never-nevers who just sort of put their finger in the ears. What I'm seeing is the world going from the advocates, and if I look at the impact sector and the SRI sector, it's been led by advocates, and they can rightly say, we've been doing this for 20 years. And they've been having very positive impact. But what I think we're moving to is that pragmatic stage where we're moving to a mass market approach. And interestingly enough, part of the research said you cannot talk to pragmatists in the language of the advocate. If you sort of start the conversation as if you don't do this, the world will burn and you need to become a vegan, the mass market go, no, they don't listen. Actually shaping things that are pragmatic and helpful. And I think that, you are 21 times more effective in affecting change. And that's when the industry is not well aligned. So that will only go up. Is really helpful in trying to make people realize it's also a simple decision in terms of choice. You make it once. You aren't taking your bins out every, we're not separating out and washing your cartons. It's quite a simple choice to make, and with real world positive impact. But what we're seeing is, I think, a professionalization of the spectrum. And I think what we're going to see is, and I think there's some really good work being done by the FCA in terms of trying to categorize broad understandings. And I think it is helpful, and I'm campaigning massively along these lines, is I think consumers need simplicity. And so if you can say that there are 3 types of general savings products, and the pros and cons of, let's call it responsible, the light green version does this, and this is how they operate, and these are the outcomes you may expect from it. And there are sustainable funds, and the pros and cons of this, and then there are impact funds and the benefits and drawbacks. That's a conversation that any IFA can have. It's the same as you discussed of the difference between a real estate fund and an equity fund. Rather than ask, and I know, because we don't have the customization tools at the moment to say, what do you want, Mr. Client, exactly? I can walk into Audi and they can offer me a selection of choices, but they don't offer me the submarine version. If I walk in and ask for a submarine car, I get told, thanks, we don't have one of those. At the moment, we're sort of, they've been given donkey sanctuaries and, type 2 plastics, and they're then looking across the range of spec, how do I satisfy that demand? So I actually think starting with what we can deliver and then being able to define that better will really help, both in innovation, because we'll then be able to have products that deliver that, but also in helping educate. What are the types of, and look, in 10 years' time, I'm sure there'll be a far broader spectrum with more pinpoint accuracy. But I think at the initial stages, having those broad categories will be really helpful in helping asset managers define, because at the moment, a sustainable fund tends to be painted green and has to have a windmill attached to it. And some very nice platitudes about we do good, but not a lot of detail in actually how it's delivered, or certainly not much reporting in terms of the actual credentials of what it does. That needs to change. But if you can have those broad categorizations, I think that will be really helpful, not only for the industry, but in terms of helping end consumers understand what is possible today. Now, that'll change and improve, but I think that's a really first helpful step to move forward.
And just to build on what Clive and Gemma have said, so I think how we talk to customers and the language is really, really important. So we looked a couple of months ago across all the kind of UK banks' websites and what they were saying about sustainability. And it's largely about what the banks are doing. So it's talking about, we're doing this, we're doing that. And with a couple of exceptions, it's not talking about what the bank can do for the customers, how to help them become more sustainable. So I think it's that sort of mindset shift to kind of start with the customer, understand some of their needs and motivations and their level of understanding on this topic. And then, as Clive says, offering them some simple options they can help navigate and understand through it. That's where we need to go till we get to a place where, people that have, I suppose, more sophisticated understandings and needs around what they want.
But also, I think with the banks, it's also what are they doing with their money? I think we've talked about pensions, but also where is your current account and what are they doing with that? And I think that's becoming more and more important. You probably saw that with the recent, shareholder motion at one of the big UK banks. But I also think I agree and type, we need to get better with the labeling, because at the moment it's ESG funds. What is an ESG fund? It could be anything. Baseline now, I think, is what we expect is that people are thinking about integration and stewardship. That's your baseline. That doesn't make it an ESG fund. That's just, I think, good investment management. Then there are other, techniques that you use on top of that. But this ESG fund is just laziness, and that's where we're having the issues, why people are confused. And when you see a headline, why does this fund invest in this? Well, it does, because if you actually read all about it, you can understand why it does. But the headline is, oh, well, it can't possibly because it's X, Y, Z. And I think we need to work more on that. And I think, obviously in Europe, they've got the SFDR regulation and about classifying funds. But what's interesting, I didn't realize this, there's no policing of that. So it does seem pretty random to me that you could be saying, well, we're, Article 9, so you're whatever, you're creme de la creme or whatever, but there's no one checking that. And again, whilst we don't want to be, I guess, whatever you call it, a nanny state or something, but it does seem strange that these products can be sold and marketed, yet no one is actually looking at that. We've obviously seen, the FCA Dear Chair letter, And maybe the UK is going to be tougher. I think it has to be, because otherwise, you know, if you bought something that's marketed as an Article 9 fund, you're probably, as a fashionista or an advocate, going to be feeling pretty good about that. So I think, you know, we need to be tighter about this, and the hurdle has kept going up, and I think it will keep going up, and that's the right way for us to move.
Certainly on that, the UKSIF view on this is that when there isn't, you know, the clarity, or when it's almost the Wild West, that anyone can say anything about their fund in terms of its sustainability credentials, that actually harms the people that are doing the most. It harms the leaders that are really driving things forward, because if anyone, to Clive's point, if anyone can slap a picture of a wind farm on the front of their brochure and say, look at that, look at our great green fund, it just undermines confidence in the entire ESG industry or financial services and work on ESG. And we know that there's some amazing leadership going on in the industry. We see it through our membership all the time, but those leaders are harmed by the general approach to concern. I think, you know, something Clive said was, you know, IFAs can do this, IFAs can look at this. You know, IFAs tell us that they're really struggling to identify which are the funds that are really actually walking the talk, and which are the ones that are kind of doing a nice marketing brochure. I mean, Mark, I don't know whether anything about that came up in the research in terms of, you know, understanding of whether something is really doing what it says on the tin.
Yeah, I mean, there's concern about greenwashing. So it is a topic. People, I think, felt that, you know, where the kind of levels of trust in kind of banking over the last sort of 10 years is affecting that, and this need, therefore, for more information. So how can I be confident? But then this slight dichotomy that more information, it's actually very confusing, both on sustainability and on some of the kind of financial products and the complications around those. So, you know, in some ways, it's a bit of a quandary, but if you can solve that, that becomes quite a powerful offering and differentiation you've got. So that's where the kind of innovation and ingenuity is needed to kind of cut through some of that complexity and provide some simple messages which are backed up by what you deliver, and kind of that trust being built.
I couldn't agree with you more, Mark. The funds that we launched at the beginning of the year, one of the key components was how, you know, my view has always been a fund has an objective, a process, and an outcome. So set the objective, be clear, you know, show the process you're going to try to deliver that, and then report on the outcome. And when we talk about risk and return, those are standardized measures, fund to fund, easy. The minute you start talking about the level of responsibility or how you're delivering on that, it becomes a nightmare. And look, to be honest, I've generated a 30-page ESG report for each of the funds we manage. I don't think anybody wants that. But we have a 30-page report because I'm downloading and comparing 360 different data points across all the issuers we invest in. And we're trying to improve a lot, most of them. But who has the time to read a 30-page report? Now, we do it because I want greenwashing to become front and center of everyone's focus. And therefore, thank you, but we're not. We can demonstrate absolute outcomes. How will you monitor that and deliver that to somebody? You know, I don't see how you go on AJ Bell or wherever you go on and buy your stocks. It says you look at the return of a fund over 1 month and 1 year and 5 year, or a return of a fund, and then you look at its risk and its, you know, maybe volatility and drawdown, and then how is it responsible? 30-page doc, it doesn't work. And so that, now the trouble is within that 30-page document, there's gender diversity, there's board independence, there's carbon, there's climate, there's pollution. There's so much that matters to many people, but one of the biggest problems, and it's actually led me to launch an academic research paper that I'm working with the ex-head of the CFA of the US and Professor Dimpson of Cambridge, is we've spent 20 years focusing on corporate sustainable reporting. We haven't got very little focus on fund reporting. And at the moment, it's a lot of platitudes and a lot of pictures. It's not really fact. And how do you deliver that in a measure that is measurable? So we've trying to create. I think it's certainly not a solution. I'm very clear. It is raising the questions and making some suggestions, which we hope will be developed on how do we make investment funds comparable? Because at the moment you're not comparing apples with apples. You're comparing, you know, swimming pools of oil, and I've even seen the number of trips it saves you to your recycling centre. I have no understanding how that is comparable, but what we need to do is create ways so that consumers have ease and trust. Because at the moment, if everyone's reporting it differently and you don't believe the numbers, it's not from a third party, you're going to lose trust. And you're right, I think, James, what you don't want is you don't want the bad actors impacting and having a negative impact on the positive actors. I think now a third of global assets under management are moving to ESG. And the first paragraph of our academic paper is, so what? What has it actually done? Can you tell me? And the answer is no, we can't show it directly. There's no one who can tell you what that asset flow has actually led to. Now, I believe net zero is a brilliant example of a very specific goal, Paris alignment, creating some frameworks to how you do that and how you deliver it for a specific goal, and then how do you integrate it into an investment fund. And I think that will be an unbelievably powerful, but it's quite narrow in its focus. So, if you're looking for a fund to do good on, global climate alignment, I think net zero is going to be a brilliant illustration of the power of asset management to help with that. But just doing good, and this is where I think the issue also lies on clients, you can't just, go to the doctor and say, make me better. You go with something that needs to be fixed. And I think there is a component there that needs to be, the expectation on asset management industries need to be a little bit better defined. And then the fund you're investing in can deliver on that expectation. I think doing good generically is quite hard, given that there is a different answer to that from every different investor you speak to.
Thanks, Clive. We've got a kind of question that's sort of linked to this, I think. But so Terry Roundtree asks about it's that question about whether your fund, this stat from Make My Money Matter that changing your pension can make 21 times more impact than doing other things, which is not a stat that's without its critics, I suppose. But I suppose the question from Terry is what can we expand on that? What are the assumptions underneath that? How what are the things that mean that that's 21 times better? I think it comes back to your kind of so what point, Clive. You could move all your funds and it not make a lot of difference. You can move your funds, it makes an enormous difference. You could change the approach and the focus to stewardship and other things. It could have a really big impact. So it would be really good to dive slightly deeper into what a sustainable fund can actually do, and let's start that education process off now. I think there's a few people on the call that are very interested to understand that a bit better. Mark, if you want,
I can give a view of my understanding of it. So I think what they've looked at is that it's about kind of carbon footprint, and looked at the impact of a number of lifestyle choices. So reducing air travel, so not stopping it but reducing it, reducing car journeys and taking the train, reducing meat consumption. I think there's something about less time in the shower, reducing energy consumption. But there's a sort of set of what you would deem sort of reasonable expectations that you could do, rather than completely changing your lifestyle. And looked at what the kind of carbon footprint reduction of that would be, and then compared it to holding your pension, not investing in fossil fuels, and the impact that would be. So I think that's how they've done the comparison for the 21 times. Now, clearly you can have a discussion around whether those are the right assumptions. I think part of why it's interesting. So if you look at there's similar but different research done by Nordea Bank earlier this year with a different set of sort of base assumptions and impact, and that came out with I think a 27 times. So if you kind of stand back from the specific detail of your assumptions, though, you're talking about something which is a order of magnitude multiplier towards things that you might consider doing. And I think that's the headline message for me. So whether it's 21 times or 27 or 15, it's an order of magnitude more than these other things that people are quite often focusing on their lives. So therefore it becomes something important on a topic that's really important for people.
Gemma, I don't know if you've got any thoughts on that.
I mean, I think sometimes the difficulty is accessing this for people. You know, they've got a pension. What are they being offered in terms of, you know, what they can invest in? And quite often, if you look at, say, employer pensions, is there may not be an option that is sustainable. And I suppose part of that is trying to educate people to raise their voices, to kind of say, well, actually, we would like different options. And why have we got these options? Because I think some of the options probably being offered are very dusty and have probably been on the shelf for 20 or 30 years. So but it's also, if you know, if an average person goes and said, well, I want a sustainable option for my pension, that's probably not going, you know, where are they going to go? How do they get the education about what is actually available? And I guess that's what we all need to think about, is how do we make this more accessible so people have the opportunity to take that choice? Because I think, you know, where your money is invested, be it your pension, your cash, you know, which bank you use, that obviously has an impact. You know, it's I always, you know, occasionally you see someone and they've got Primark bag in one hand and Whole Foods in the other, and I'm always fascinated by what their kind of mindset is. But we will all have certain things that we will do, and obviously you can say there isn't an impact or there's a small impact, but every single impact makes a difference. You know, it's a bit like when people say, well, you don't own much of that company, why are you voting at the AGM? Well, I only have one vote when I vote in a general election, but that can make a difference. And I think there's been a report out from quite recently saying actually your voting decision is one of the most biggest, you know, kind of impacts you can have on your footprint. But of course, you know, then they were looking at it and kind of going, yeah, but it depends whether they actually deliver what they promise, which obviously is a big question with any political party. So, you know, but there's all these different steps that we can take as individuals that hopefully will make a difference. But I guess it comes back to that education point, and how do we make it more accessible for people?
So, Gemma, something you just said is very linked to Francesca's question in the Q&A box, and reminder to everyone to please keep feeding us questions, because Francesca's working with teaching people about aligning their personal finance with their values, and asked about the role of employers in terms of exactly what you just said about the choice of pension funds on offer, or the different options available. Even if somebody were to say, yes, I want to go right now and make my pension more sustainable, what can they do about it? And what is the role of employers in that?
I mean, I guess different employers will have different functions. I mean, for example, we've got an employee forum. You know, we've had a consultation about this kind of thing, about having these options as part of a wider kind of plan across the business. So I guess it's finding that route in to the people who make those decisions, and it will be different in every single company. But I think that's the route to take, because they're the people who are making the decisions about what's available on your pension platform.
If I could add to that, interestingly enough, and this is a great precursor, I think 70 to 80% of assets are always in the default scheme. So if you work at a company, which tells you that no one's paying any attention at all, because they're just allowing it to go to default. So they are not engaged in how their money is coming to view. Now, my personal view is that nearly, you know, if you're an employee or you're an employer, your default scheme should now reflect your purpose of your business. And if you want it to be more sustainable, find some, you know, responsible or sustainable investment products that become your default. And so that will then shift 70 to 80% of corporate pensions into those types of assets. I also think there's quite reasonable view for lobbying the government to make ISAs only applicable to responsible or sustainable products, because that would shift a huge amount of focus and allocation onto them. It would also force the industry to shift as well. So I think there are lots of practical ways. Now, I still, as I've argued at the beginning, I don't think that the responsible, sustainable investment spectrum is perfect in any shape, way or form, and I think it needs continued development. But I do think, as an employer, having that as your default scheme and reflecting the purpose of your own business and what you're espousing and your employees are espousing, because that hopefully is what the firm stands for, is reflected in the default, or at least having on your self-selection, because most funds will have a default and then maybe 20 self-selection options, that those have large amounts of sustainable investment options I'm glad to say that the 5 funds that we run were put on as 5 default. They weren't put on as the default, but they were put on as 5 of the self-selection so that people have that availability. And I would counsel all businesses to be able to offer that to their staff.
How do people understand what's in that fund, Clive, that's different to what would be in the standard fund? Because, you know, I know that you've put a lot of thought and effort and time into making that a really great ESG fund, but how does somebody that, you know, isn't listening to this conversation able to understand that?
I think the key is to be clear, because some funds will say, we will never invest in oil and gas. And then maybe that's what the client wants and the investor wants to choose. I'm not for that personally. I believe that we should be ensuring transition, i.e. that company needs to go from A to B and get better. Because I think this is a journey for all of us to be on in terms of, you know, this is for focusing on net zero and carbon. So for me, running a fund is all about trying to get that improvement through. Now, I'm a multi-asset investor. I'm top down. I don't engage directly with companies. So I always feel a bit of a fraud, which is why Gemma and I meet a lot, because I've decided that one of the ways I can be effective is to try to influence at a national or at an industry level rather than at a company level from a bottom-up basis. But my colleagues now are working, and if I look at net zero, is a good example of what I hope the future brings. That is all focused on trying to get companies to get to a net zero pathway to be Paris aligned for 2050. And that is basically forcing companies to either invest in companies who are doing better on that metric. So the metric of how much are you aligning to net zero, and a commitment that over 5 years, you increase the percentage of your fund along that curve. So you may start today with 80% of your companies you're owning not aligning to net zero, but you'll commit that it might be 50% in 5 years' time, and then it'll be 70% in 10 years' time, with a view that in 15 years' time, it's 100% of the companies you invest in that align. But your job is either to deselect those companies if they're not doing what you hope they'll do, but also to engage directly with them to get them to affect positive change. And there are people like Share Action and Climate 100 who are setting industry-wide agendas saying, yeah, what we want you to do is go to the chemical sectors and the chemical companies you help and say, is your CEO now being paid on ESG goals? Do they have a carbon reduction policy? Are they delivering on that? Are they committing capital to deliver? And if they're not, then you can't move them along that curve. Now, that's a really specific approach. But the trouble is you find people saying, you've got Apple in your fund. That's not, because that doesn't fit to their own personal view. So the point is, for me, you have to state at the fund what it is you're trying to achieve and how you'll do it. Because some will be very exclusionary. And if people want to exclude sectors, that's perfectly valid for their choice. But if it's a fund that's trying to be transition, then it's all about then explain what that means and explain that you're going to try to foster businesses to move along, but you're not going to exclude businesses because you want them to do better. That then can mean that when a client goes, oh, okay, I understand that. So you will own those businesses, fine. Because the worst thing you can find is someone buys a fund and says, well, why do you have Facebook? I don't like Facebook. And you're like, that's a difficult conundrum to target. Now, clearly, if a company is in child slave labor, then it's a pretty industry standard that's not acceptable. Let's get rid. The difference is, in terms of others, it can be there needs to be specificity at the objective and understanding of what that is for clients, so that when you then see what you hold and what your outcomes are, that they're aligned with that objective. Because it's complex and there are different flavors and different tastes, and people need to understand, because people have different views. And I'm not here to lecture my investors about what their views are or their ethics.
Mark,
fund managers to represent those.
Mark, so Clive's just introduced a lot of complex topics here, which are things like, the nuances around stewardship versus divestment versus, tilting and other things. It is complicated. It is a complex area. We can't pretend that everything non-financial in a fund is going to be simple and straightforward, but yet the research suggests that it needs to be simple and straightforward, and that these nuances are very hard to put across. How do we square that circle? What does the research show us?
So I think what Clive was saying, it's about the sort of top-down messaging. So starting with, well, what are we trying to achieve and how do we do it? So the research showed that people care about different aspects of sustainability. So environmental protection kind of came up top. Things like health and well-being were there, and further down, things like social justice, equal opportunity. So So we've got this hypothesis that people will increasingly want their money to do different things based on what's important to them, what their values, which I think is what Clive was saying. So stating that at the top level, along with the investment, the kind of risk and return objectives, setting that out becomes quite clear. And then for me, what I've seen, even in my personal finances, how that is operationalized isn't necessarily clear. So it means we're going to hold these funds and use our voting in this way, or we're not going to invest in them. So that clear messaging, which then is kind of backed up with the detail of how you want to do it. If people want to drill into that detail and there's that line of sight to it, I think that's where we need to get to. So it's clarity of messaging and structured messaging. So the detail's there, but we present the kind of simple messaging around it.
Thank you, Gemma.
Sorry, just to add to that, I mean, I also think there's a danger that people hide behind kind of external ratings. This rating agency said we're or whatever, and we're better than the benchmark. And I'm kind of like, I have no idea what that really means. And it can obviously still hide an awful lot of different other factors. And it makes it very simplified. I think most managers in this area, we don't just use one data source, we use multiple, because it's a lot of this, going back to Clive's point, it can be a bit fluffy. Quant data, fine, but a lot of this can be qualitative views, and we need to take our own view, and we need to take raw data from other sources. So we've seen it, certainly it's a danger. It's like, well, it's rated A or whatever, or because of this recycling bins, or this is the equivalent to 35 cars. What does that mean? And I think that's where it gets a bit confused about what is outcome and what is impact investment. And there's a real danger that the line between those two gets really blurred as well. Sorry, we're not saying very much that's positive. I think it just shows that it's still we're still evolving.
That's great. I mean, in the final couple of minutes that we've got left in this panel, I just want to come to Rhiannon's question. So Rhiannon's a geography teacher, and is asking really a question about how she can have the school think more positively about this. But I want to extend her question a bit more to sort of think about the next generation, the kids that are currently in school. How do we, their whole lives are going to be shaped around the success or failure of us in the next 10, 15 years to make the changes that we need to make. How do we educate the next generation on the role that financial services can play in moving us forward?
I mean, there are some industry initiatives already, and we are part of them, so it's not an advert, but I think lots of other people are as well. And I think that is really important, actually going into schools, so it isn't, you don't just hear blah 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 when someone talks to you about a mortgage or pension or your bank account. And I think probably the financial services industry needs to do more of that, but also perhaps the government should be thinking, well, where are practical help sessions actually on the school curriculum in terms of how financial advice, because it's the reality in this country that probably the more in need you are of financial advice, because you've probably got less money, the more perhaps harder it is to access, or the more it costs you in percentage terms. I'm talking that across the board. That's not aimed at IFAs, it's also aimed at investment managers. Our fees go down the more money you've got, which always sounds quite bonkers as a percentage point. So I think it is about getting that access into the schools and into the education system so that people learn from a young age and it's not a scary topic.
I've always slightly joked around our dinner table that home economics, which used to mean a very different thing, but home economics are reintroduced as a GCSE. My view is, if helping educate people in terms of mortgage available finance, how to save, how to invest, is crucial. We are putting the onus on the individual to look after themselves in later life more than we've ever done before. And that does require us to skill people with the information. And I think if that was brought into the actual curriculum and education, that would be excellent. I think that would be, a better educated consumer is always going to be, hold systems and people to account in a better way. So I've always thought if it actually was brought in as a part of the curriculum, that would be an excellent step forward, because otherwise we always want to say it, but it's very difficult to as a firm to change the level of either interest or aptitude. I'm not sure I'll ever change the interest level. I'm not sure people are ever going to be that excited by finance. It's not the Premier League, and I can get over that. But I do think their knowledge and their ability and should be better, so that they hold us to a clearer both objective and to account.
Yeah, thanks, Clive. And that alarm as a reminder, we are just right at the end of the session. So Mark, I'll leave the last word to you on the future and where we move.
Yeah, so just to kind of recap, our view is that consumers are ready for sustainable finance products. The research kind of backs that up, and it's really kind of question for firms in the industry to look at how can they engage in what is a difficult and complex subject, but how they can work to innovate and empower the conscious consumer. And I think those that do will be successful going forward in terms of the customer relationships and the business that they generate.
Brilliant. Thanks, Mark. Just a final question from Al. It's not a question, it's just more of a statement from Alistair Coots-Britton, who says he's an IFA. And in his experience, clients are not all engaged with the content of their portfolio, and ESG needs to be sold as a concept and shown to be at least no worse and no more expensive than a conventional portfolio. And if you show this, then clients become very enthusiastic indeed. So that's, I think, a good point to end. Thank you all very much to Gemma, Clive, and of course, Mark, for this fantastic opening session of Good Money Week. Really have enjoyed it, and thank you everyone for asking questions. And we're gonna, without further ado, hand right over to our next panel, and I'm going to pass over to Roberta Samueltelli, who's Head of Membership Services and Business Development at UKSIF. Roberta, over to you.
Good morning. Thank you, James, and good morning to everyone. Welcome to our panel on